Hello YouTube, welcome to Mindful Investing. In this video, I want to talk about 3 stocks you want to buy for September 2020. I'll talk about the company, the ticker symbol. I'll talk about the company background, what it stands currently and where it can go in the future. I'll give you my bullish thesis around the company, and just do your research, guys. This is not a financial advice. This is a recommendation, and let's get started. First company is called NV5 Global, ticker symbol NVEE. I'm sure you have not heard about this name before. This is not like well-known name, but this is really valued company right now. And this is basically focused on construction, right? So building infrastructure and all that. So NB5 is a leader provider of compliance technology and engineering consulting solutions for public and private sector clients, supporting infrastructure, utility, and building assets and systems. The company primarily focuses on 6 business verticals: testing, inspection, and consulting, infrastructure support services, utility services, program management, environmental solutions, and geospatial technology services. So basically, their main area is infrastructure, right? So which is very critical, and they are a worldwide company, and they are growing massively. And its market is not, valuing it as such, because even though they did very good second quarter earnings, they stock keep going down and down until recently, right? So this is still a very good addition to your portfolio, and this will give you a good return. All right, so facts at glance. This is the leader, leading provider of compliance technology, engineering consulting solutions with 70 years of history. Is number 27 on the ENR top 500 design firm list. Is number 13 on the ENR top 100 pure designer list. More than 100 offices worldwide. More than 4,000 employees. They are really doing great on what they are doing, and they have massive potential. All right, let's talk about the numbers. Or look at the quarterly earning report, right? So they grew 27%. Net revenues, it was up 29%. EBITDA 46%. That was a huge growth. They earned 26 million, EBITDA. And with all the the EPS was 93 cents per share. So that's really really good. And comparing to second quarter of 2019, they grew massively. The cash flows from operation was 3,000%. That's an amazing number right there. And they have 65 million cash in hand, 211 million account receivable. They have very good financial portfolio as well. They are really good from the balance sheet side, and since they are expanding in multiple areas, they have massive opportunities to still grow in the future, and they have like a couple of good acquisitions recently they done that will help them to grow more, right? So, and they have a lot in their backlog. That means they have yet to execute on those backlog items, and they'll be bringing more revenues in the future. So this is a very safe company to invest. And if you are like value plus growth investor, this is a good one to add to your portfolio. And look at the valuations currently. It is trading at 16 forward PE ratio, right? So it's pretty relatively cheap compared to market. And looking at the market cap, they are trading the same market cap, 871 million, which was last year. It is trading less than that, right? So that makes it extremely valued, right? And look at the price to sales. So it is very low compared to last year. So it has a very good potentials to double in next couple of years. or if not, in next 5 years. So this is a really good addition to your portfolio. And just a disclosure, this is my largest holding at the moment, and with the current market dip, I will try to add more, or let's see, since it is already a massive in my current portfolio. Let's see if I want to add more, or I will find other good opportunities. And look at the cash. They have 65 million in cash, and total debt at 394 million, so which is relatively more than total cash, but their assets are really high, so nothing to worry about. And their book value is $28. And look at the income statement, and their revenue has been growing consistently over the years. So look at the quarterly earnings. They did really good in the last quarter, even with this global illness that's going on around the world. So they are doing still better, despite of all this negativity around the world. So this is really good sign. And let's see what is their what is the analysts are saying in the future, right? So what is their growth perspective? They are expected to grow just 4%. That is wrong, because since I follow this company closely, they have records of beating their estimates and their guidance, right? So this is very low estimates. Maybe analysts are not revising it. They will revise it in the future. But with a 20% growth, the company is trading very, very cheap right now, since the price is $52. And looking at the historical valuation, this is pretty low. All right, hope you like this company. Let's move into the next one. The next company is not other than Foot Locker. So as you all know, this is a very popular company because they sell shoes, all the branded shoes. If you have been to the malls, they most likely have seen this Foot Locker store. Usually they sell lots of good shoes, right, that you need, right? Okay, so let's dive into the details, why I like the company. And even though they have closed a lot of stores during second quarter, but they did amazing on their online store, right? From online footlocker.com, they have sold a lot of shoes recently, and their online sales has been growing. So they are doing really good on the online side. So that's also a good thing that I like about the company. And the numbers is amazing. They have very good balance sheet. We'll talk about it later. So let's see their the monthly, the last year's sub chart. You can see company has a lot of roller coaster rides. It went to like $24 back in 2005. It went down. It has a long history of revenue growth. It went up to $75. It went down. There is a lot of ups and downs. And it is expected. Since it is in retail environment. All right, so let's talk about the numbers. The market cap is around 3 billion right now. The enterprise value is 5 billion. Now the trailing PE is 17, forward is 21. It's not cheap, based on the metrics of PE ratio, but since they are growing amazing and they did really good numbers in last quarter, even though in this global sickness or in global illness, they were able to make a lot of money in the second quarter. And they were was able to grow the revenue, so that's a really good sign. They are very less impacted, even though they're impacted a lot, but they were able to pull it up with the good management and the good balances they have. And cash, they have 1.37 billion in cash, which is amazing, which can allow them to acquire more good companies or invest on their own supply chain and all their business as well. And their debt is 3 billion. I look at the numbers, income statement. Looking at the numbers, you can see their revenue is growing consistently, even though they had like less revenue last year, but they have been doing really good recently, right? So this is the quarterly one. Let's look at the annual, and look, you can see their revenue has been growing consistently. And net income you know, last 12 months is 194 million, which is not bad. All right, so this is really, you know, fairly valid right now. It was hovering around like 27 or $28 like few days ago. Now it is back to $32. I like the company, you know, as long as it is like below $35. I would add more if it goes back to below $30, right? So looking at the analysis, companies, you know, sales growth is expected to, I think this is wrong because they still was able to grow the company, so they will revise it, I think. But you know, they're still, you know, they're expected to grow maybe 6% next year, but I think that might be also, you know, need some revision because they are doing amazing on their online sale. How do I see they are doing amazing on the online sale? Looking at their foot traffic, I mean the foot traffic on the website, right? So look at the numbers. You know, back in May, June, and July, the numbers has gone up 20 billion. Right, so this is amazing. You can see they have almost a double the users from the, you know, March and April level. So this is really good sign. They are doing really good on the website as well. And there is an expectation that, you know, there is a second stimulus will be released, and that will be a good sign, you know, for the company as well, because consumers will love the shoes and they will, you know, go to their websites and buy those amazing shoes. And the third company I want to talk about is Roku, which one is really excited to talk about. All right, let's go to the details. Roku, you know, do multiple businesses. You know, as you know, if you have, you know, some of the TV that has already Roku installed, you know what the Roku does. They have, you know, a lot of TV accessories. They have you know, the player accessories that you can connect to your, you know, SD TV and make it more smart, right? Smarter. You can also have some, you know, streaming stick. They also sell some, you know, the speakers. Even though it looks like, you know, how this company is really, you know, just selling those products, you know, you might have a question, right? How this can be a value play, right? So, and how they are growing. And you have to look into the, you know, details, like see why they are growing, you know, this big, right? And why they have a very good future. Because as you know, with this, you know, global pandemic, people are staying at home and they are, you know, using TV, right? And what they do, they play the TV, something, you know, anything on the TV. Whenever they play, they see ads, right? Basically, you know, if you are watching from the Roku streaming devices, and whenever there is ads coming up, and they are getting the revenue cut of it. So that's really important to understand. And also, whenever you are watching Netflix or maybe Disney Plus, and let's say you are subscribed to Netflix or Disney Plus, and you are paying monthly services, and they get a cut of it. So basically, you know, they have, you know, a recurring revenue, you know, even though they don't have their own you know, app, they still have their own app, you know, even though you are using somebody else's app, they are still getting the money cut, right? So this is really important to understand. A lot of people don't understand that, so that's why they are avoiding the stock. But if you understand all those metrics, you know, it has a very good potentials to, you know, grow much further. Let's dive into a little bit more details. Look at the second quarter earnings. They grew 41% on the active accounts. Amazing, you know, mid of all this pandemic, right? So, and also streaming hours, it went up 65% year over year. So that's amazing. They are growing massively. The stock value is under, you know, not overpriced, right? So that gives it much more potentials to go further, you know, and it is still a good addition, you know. Now look at the profit, right? So EBITDA, adjusted EBITDA is 3.4, negative 3.4, you know, this quarter, recent quarter. But they have, this is a huge improvement compared to last quarter, right? So they are doing better. I think they are very close to profitability. I think you know, they said they will be profitable next year. So, you know, it's really good to know about that, and that makes the investor, you know, stick with the company. And look at the, you know, chart of the Roku. It has gone to around $160 back in 19, and it went down significantly, you know, in the March crash. But you know, it was very slow to come back, but it has come back to that level. But with this, you know, current performance, the stock price is not appreciated. So it is a good addition still in this level. So I know this is my maybe fourth or fifth position, largest position in my portfolio, and I believe this company will be more than $200 by end of next year. So this is still has a good upside. It will definitely outperform the market. Look at the current market cap of the company. It is valued at 22 billion, which is not that much compared to other valuations, and price to sales is 15, which is relatively very similar to their historical price to sales, and also the price to book is 21, which is not bad either, right? So since they are still growing a lot, this is a very good addition, and I would love to add a lot whenever the stock goes below $150. Right now it is fairly valued. I think they still have a good run for the end of this year. I think it'll be around 170, 180 unless the market crash, right? So this is a really good company to keep it in your watch list, or start nibbling here and there whenever the market crashes. And look at the the analysis statement for their growth for next year, right? And this year, right, this year they are estimated to grow 40%. That's amazing. And next year still they are growing 34%, and this is really good to know, right? So this will help investors to hold the company shares, and that will appreciate a lot, and they'll be rewarding for them in long run. All right, so hope you like the companies that I recommended in this channel. And please, if you like this video, please hit the like button down below. That'll help the channel. And please don't forget to subscribe. I'll bring more videos if you like it. All right, so stay safe, stay healthy. Until next time, take care, guys.